Good morning and welcome to the street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Brian Teich, Chief Investment Officer at Avenue Investment Management, will be joining us for the hour. Then in 30 minutes, we'll be joined by Allison Freeman, CEO of Elements Event Solutions, to discuss their new product investment. And of course, we want to hear from you. Call us with your questions on North American equities, and we'll have Brian answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about a half an hour. You can also email us, of course, and that's firstcall@bellmedia.ca. Now, some of the stories we're working for you on in the BNN Bloomberg newsroom. March home prices in Toronto fell to their lowest level in more than 5 years, according to data from the Toronto Regional Real Estate Board. The benchmark price of a home in Canada's largest city dropped 0.6% from the previous month, and it's the lowest since December 2020. Home prices declined and the supply of listings remained elevated. However, Toronto home sales in March increased for the first time in 6 months. Billionaire activist Bill Ackman is proposing a $65 billion U.S. deal for Universal Music. His investment firm is pushing to combine the music company with a U.S.-based acquisition vehicle. The pitch puts a 78% premium on the Netherlands-based company's last closing price. The deal would force through a U.S. listing that UMG has so far delayed. The world's largest music company, UMG houses artists like Taylor Swift and Drake. Anthropic says it is on pace to top $30 billion U.S. in annual revenue. This is up from $9 billion at the end of 2025. The American company says demand for its Claude service has increased in 2026, with more than 1,000 businesses spending more than $1 million U.S. on an annual basis. The AI startup is also confirming its plans to work with Broadcom and Google to power its operations. And now, our top line story. Markets are watching U.S. President Trump's deadline on Iran more closely, of course. It's approaching. Oil's holding above 110 a barrel ahead of the ultimatum to reopen the Strait of Hormuz. For more on the latest, we are joined by Tyler Kendall in Washington. And Tyler, thanks very much for joining us. Where do we sit right now? The markets are kind of mixed right now. I don't think they know what to do with this.
Right. Well, because at this point, Roger, President Trump said yesterday that it depends on what Iran does today, whether or not the U.S. is going to wind down or escalate operations tonight. Now, we are getting reports that some attacks on infrastructure have already started, as Israel confirms that it's hit dozens of infrastructure sites in Iran this morning. And now Axios is reporting that there has been military targets hit on Karg Island. Fox News saying, though, that these only include bunkers, radar station, and ammunition storage, but that loading docks have not been hit, or at least not hit intentionally. Because yesterday we got a little bit more clarity from this White House on what they need to see in order to reach a deal, as President Trump maintains that the Strait of Hormuz has to be open as part of any such agreement, which sort of counters last week when the administration appeared to imply that it didn't necessarily need to be open in order for there to be a short-term deal. Now, of course, President Trump could still delay his decision, and these threats coming tonight at 8 p.m. Eastern. For example, yesterday he said that he felt that Iran has actually been negotiating in good faith. He also cited what he said were communication issues with Iranian leadership, citing security concerns that's hampered their ability to communicate with the U.S., citing that as one reason why he has previously delayed this deadline before. But still, he maintains that it is, quote, highly unlikely that we could see another deferral as Iran continues to take, at least publicly, a hardline stance.
And do we have any details on Iran's response to any of this? What are they saying?
So yesterday we had gotten through Iranian state media that Iran was rejecting a ceasefire proposal. There had been media reports that the sides were working on a potential 45-day short-term agreement, but Iran has maintained that it wouldn't be in their best interest to agree to a short-term deal. They say that they want a longer-term deal, alleging that a short-term deal would only allow the U.S. and Israel time to regroup. Instead, they have put forward a list of 10 top demands that they need to see in order for the conflict to be resolved from their end. But many of these points are considered to be non-starters, including Iran having sovereignty over the Strait of Hormuz, something that is not going to fly with the U.S. and its allies. So at this point, publicly, there is this very hard-line stance coming from Iran, but still, President Trump says that they are still having good negotiations with leadership he says is a lot more amenable. But at this point, we haven't really seen anything, and it appears that the sides are still very far apart when it comes to this, including, of course, on that main point of the Strait of Hormuz, Iran saying last week that they were going to start to charge tolls on those ships that are going through the waterway. President Trump was asked about that yesterday, and he said that he thinks the U.S. should be the ones collecting tolls. We know regulations and rules like this is something that the U.S. does not want to see put in place going forward.
All right, Tyler, thank you for that update. Bloomberg's Tyler Kendall. Now let's bring in our guest for the hour, Bryden Teich, Chief Investment Officer at Avenue Investment Management. Bryden, first of all, thanks for joining us as always.
No, great to be with you, Roger.
It's so easy to figure out what to do right now, isn't it?
I was just thinking that myself. I think it's.
I think roll the dice and away we go.
It feels like what's happened in the last week is the market has increasingly ignored all of this, assuming that there's no way to gauge because we've had now the deadline change multiple times. Mm-hmm. Like, if you listen to what Iran is saying, they're saying, we don't agree to any of this and we're not talking.
Yeah.
The U.S.'s administration is much more incentivized to try to normalize transit through the strait because of the impact on global energy markets. I think the market is at a standstill just waiting to see what happens with the U.S. because Iran clearly is.
Well, and they were up, so we're just looking at them right now, the futures, they were up slightly earlier. So, I mean, what spooked them now?
And I would even say Iran's sort of, it's pretty clear to see Iran's playbook, which is, of course, Iran cannot militarily match the U.S.
Yeah.
They're holding a grenade, they've pulled the pin, and if Iran is attacked, they are going to attack Gulf state infrastructure for the energy market, because that's all that they can do. And that's would be a disastrous situation for Iran's neighbors and also the U.S. and I think consumers in North America and in Europe and Asia, where you're already seeing the impact felt the most. So I think it's important not to dismiss this. There's a lot of sort of, kayfabe theater going on with this.
Sorry, what'd you call it?
Kayfabe. That's what wrestlers do. So it's like, have you ever heard that term? Kayfabe?
Never heard kayfabe.
Yeah, so this is what I would, there's a lot of kayfabe going on here. But you cannot dismiss the fact that, we are one escalation away from things really spiraling out of control. And I think investors have to be treading cautiously with all of that in the background.
And I think that's part we like, the kayfabe?
Kayfabe.
Kayfabe.
Yeah.
We kind of laugh at that, but at the same time, it's a very serious situation, but it's so surreal.
Yeah.
And it really is hard to figure out what the next move is.
Yeah, and I think it's sort of alarming, and you can almost become numb to it. And I think what I was sort of starting with is that investors have sort of become numb in the last week. This is a really live situation, and I think it's wrong to think that everything's going to go back to normal and there will be some kind of peace deal quickly. And I think it's also wrong to be extreme, hyperbolic. This is going to be nuclear Armageddon in the next 2 months. I think either of those are extreme, but you have to be open and sort of be looking at the field wide from an investment perspective, because we don't know what's going to happen here in the next few years. Now
we're into all these visuals. It reminds me a little bit of Animal House, Kevin Bacon's character. Everything's going to be okay as he's getting run over. Long term, it will be, but right now. So how are you approaching this? What are you doing?
So I wouldn't go as far to say as we've been preparing for this, but we've been watching the situation emerge over the last couple of years. I think we were very alarmed last summer when the U.S. started bombing Iran, and we're almost surprised at how quickly that was sort of resolved from a market perspective. But the U.S. and Iran have been hurtling towards this for, you could say, decades. But investing obviously doesn't occur where you're waiting for these events to happen. And so I think we've been alarmed at the escalation in the last month. We think that there's multiple paths on which this goes. We're not trying to predict which one. We're sort of, again, just trying to be open-minded to all the different outcomes. But I think in the near term, no matter what happens, we're in a situation where you're starting to have physical oil shortages in Asia. I think we're probably a week away from that in Europe. Mm-hmm. North America is immune because we're such a large producer, but
for now at least,
prices are rising. Yeah. I mean, if gas prices are up to $1.80-ish in the GTA, or $1.25 a month ago. Yeah. I mean, where do we go from here? $2.50, $3? The question then becomes, at what level of demand destruction does it take for the economy to really bite? And we're probably going to figure out in the next month, because even if this is resolved, I think there's this now supply bottleneck, physical commodity shortage, where you're seeing that. I think even in Italy, they were rationing jet fuel the other day.
Yeah. Well, so, didn't England, the UK get their last shipment of jet fuel? Just came in.
Yeah,
so they've got about a month apparently.
So we're right up against that. And I think even if the strait were to reopen in some way in the next few weeks, that bottleneck from the last month, it's going to take another month for that to flow through. And so the physical tightness in the energy markets, I think, is sort of the story that will emerge in the next few weeks. And
I mean, we are going to see the spillover from Asia, from Europe, coming here. Maybe, we might not have oil shortage, but people will have to start making decisions about if they're driving, how much they're driving, where they're going, what they're doing, and then prices for things that are coming from elsewhere, or things not coming in at all.
Yeah, absolutely. I think because it's happened. Prices are up here at the pump. They're up in the U.S., but they're not up, that much more than they would have been in 2022 when Russia invaded Ukraine. I think people haven't gotten the sticker shock yet, but another 20, 30, 50% from here in terms of gas prices, I think you really start to bite, and I think consumers then have to make those tough choices.
All right, we'll take a break on that note there. Up next, we'll take a look at the markets before the bell. See how things are shaping up on the markets right now. We'll start with the U.S. futures. And when I looked about 45 minutes ago, they were up. That was 45 minutes ago. Now you can see Dow off by nearly a half, NASDAQ by 3/4, and the S&P 500 off by about 0.6%. Everybody trying to figure out what is next for Donald Trump and Iran. And moving to Asia now. Mixed bag there. The Nikkei up, not really, but a wash there. Hang Seng off by 0.7%, and CSI 300 pretty much neutral as well. Again, it's the impact of Iran. Nobody knows what is next as that deadline approaches at 8 p.m. our time. Off to Europe now, and you can see it's the same. It's all over the place. The FTSE off by 0.1. The CAC 40 up by a quarter point. German DAX down by 0.3%. TSX yesterday continuing its little rally that it has going on, finishing again above 33,000, up by 0.22%. Mixed bag on the different sectors though. It's about a split down the middle line. Some up, some down. And taking a look at some of the winners and losers individually. MDA Space, of course, up 6.76%. First Quantum Minerals by 5%, going the other way. Transcontinental off by about 2.5%, and Stella-Jones off by about 2.7%. Looking at the metals now, and they're getting that downward pressure with oil pushing up right now. Gold's off below 4,700, down by 0.13%. Silver off by 1% at 72, and copper is down by 0.4, hovering around 560. Western Canadian Select, it was off yesterday, finishing below $80 a barrel, down by 1.27%. Now today, let's see what WTI is doing. And it is likely moving. There you go. It's up about 3%. It's over 3% now at almost 116 a barrel. Home sales in Toronto rose in March for the first time in 6 months, even as prices continued to move lower, according to the Toronto Regional Real Estate Board. Now, is Canada's housing market showing early signs of stabilization, or we still have more to fall? Let's bring back Bryden Taisha of Avenue Investment Management, talk a little bit more about this and what it might say about the markets, about our economy. What are your thoughts on when you see these numbers? It's mixed, isn't it? So more people sold, which means they probably had to sell, but the prices are still down.
Yeah, I think there's a healthiness returning to the market. I think for homeowners in the GTA, there was several decades of a great run where prices just went higher every year. I remember doing segments where home prices would be up 5% or 10%.
Yeah, if you owned a house, it was fun to watch.
It's an unhealthy market on the way up. And I think the last several years, we've had this sort of cooling. Interest rates were higher. Interest rates have now come down a little bit, so affordability and mortgage rates are down a little bit. But there's a healthiness, returning to the market. And I think that ultimately is, I think, a very healthy thing for the economy, especially the banking sector. I think the concern after 2020 and 2021, we had such a surge in home prices, especially outside the GTA. If you drew a dot in the middle of the GTA and did 3 hours around in a big circle, some of those little pockets had huge home price
and what they were paying, and the prices they were paying for those.
Yeah,
places.
and so that's really unhealthy. That prices out people in the local markets. Then the concern is that you have a large credit cycle, which then hurts the banks. All of those things didn't happen, and so I think this data from the last month, I think, is very healthy. I think if home prices at this kind of flat level, but activity is starting to pick up, I think is a very healthy development for the spring.
And the banks have had to tread carefully with this, haven't they? I mean, they had a lot of people taking advantage of those 1-2% mortgages, and all of a sudden they're coming renewal time, and they're just trying to keep. Yeah, they don't want to lose their payments from these people. Right?
I think the other thing too that happened, 4 or 5 years ago, is there were a lot of people who had embedded home equity. There was 2021 and 2022. It was very easy to go to the bank and sort of use some of that equity to buy a second home or a cottage or a rental property. And that's where, when you get that leverage on top of the leverage, that's where embedded systematic risk starts coming into both the banking system, but then the housing system. And the fact that we were able to withstand higher interest rates for a few years, the banks obviously don't want to keep everything on side. They're not in the business of repossessing homes. And at the same time, I think the fact that we've had prices now flatline for the last couple of years, I think is a healthy development. The banks have skated through this very, very well. You can get into scenarios and think about what happens if interest rates have to rise from here, if inflation goes back.
Which is a possibility now.
It's totally a possibility. But I think for now, for this spring season, I think it'll be interesting because we've now had several years, house prices have normalized, mortgage rates are down, affordability is better. If you have a lot of listings and you have affordability, I mean, ultimately sellers and buyers have to meet.
Yeah.
And if you do that in a healthy market, I think that can, again, it's sort of a check for the Canadian economy.
Yeah, and I think we're starting to see some people looking at it and going, well, I've wanted to upsize, and it was always out of the, and they're going, well, I'll take this hit on my house, but they'll take their hit on that house that I want to buy. So I'm actually saving more money if I'm going to move up.
Yeah,
so we may see some more movement.
No, and I think the longer term trend, which we've discussed for years, is that there is a structural shortage in homes in the GTA. So that hasn't changed. And so again, every year you have more people added. I think I've seen some stats where Canada's now gone to sort of flat net immigration in the last year, and we might even be going negative year over year. So all of that, I mean, but that might...
We were actually the last half of the year we were, I think,
was it negative?
Yeah.
So but you're still digesting a lot of that surge from the last 3 years. That might hurt the rental market more, so there might be, more time on market for rental units. I think it's the investors who bought 5 condos, had them all rented out, would sort of, use that to do more mortgages. Like that's where the market has been hurt, but I think the banks have really skated past that.
All right, and so goes Toronto. Does so go the rest of the country, or do you think it's?
I think there's. Alberta economy, I would expect to be pretty healthy this year with what's going on in the energy markets, but they've also been through several years of a lull after 2021, 2022. So I think you've got a healthy market across the country. I think the concern is always if you have a change to interest rates or mortgage rates rise significantly in a tight window of time, that always can cause some kind of a shock. The fact that interest rates have come down a little bit and we've had this sort of healthiness return, I think the market across the country seems to be pretty healthy.
And does it indicate, do you think it indicates people are getting a little more confident about their jobs and about job security?
I mean,
or is this just some people have to move because they've got to move?
I think there's, I think there's a lot of, like as you said, just people, you live in a condo, you get married, you have a kid, the condo's too small, you need a bigger space. All of those things are sort of part of the natural shuffling of the deck within housing. I think that the concerns about the Canadian economy with both tariffs and now high energy prices, all of those things are still a concern. But I think the systemic risk in the housing market that was concerned or feared a few years ago has not materialized. And I think for now, I think we can rest easy that the housing market seems to be on stable ground.
All right, we'll take a break on that note there. Up next, though, we'll be back with Bryden Teich and see why Murphy USA is on his radar. All right, time to see what's on the radar for Bride and Teich of Avenue Investment Management. And Murphy USA is showing up. And I love this because I was looking this company up. I'm like, they do what? They're variety, convenience stores and gas, but the gas stations. And they're massive, though. But they're not the biggest.
They're not the biggest. No, this is a business we've owned for about 3 years, based in Arkansas. And so we've been long-term shareholders of Couche-Tard, which is a Canadian business that everyone knows, Circle K. So when we looked at them, we went through what are the competitors, and again, at the time, we hadn't heard of Murphy's previously. When we looked at Murphy's, it's the retail and gas station assets of what was Murphy Oil that got spun off in about 2013. What we like about the business is that they have an agreement essentially with Walmart. So Murphy's are located essentially adjacent to Walmart parking lots, and that's sort of how they...
Nice built-in customer base.
You got a built-in customer base. At the same time, Murphy's they're one of the lower cost gasoline stations. So they essentially sell discount gas, and the idea is you get higher volume, you get customers that come into the store, all of that. Provides a very good repeat customer. They've got a good loyalty program. So we own this coming out of 2022 and 2023, and they really benefited from gas prices were higher. They were able to earn higher fuel margins. All of that was good. I think what we then didn't understand or didn't appreciate last year, so when gas prices were low, it actually hurt their business because it meant that consumers were less likely to go to Murphy's because the price differential was less needed. So when overall prices were lower, you didn't need to go to Murphy's because you could go somewhere else, and that gap was tighter.
It was not minimal enough.
So I think as we've gone back to now a higher gas price in the U.S., I think the discount that Murphy's provides, I think, is even more valuable to their customers. The question is going to be, how high do gas prices go in the U.S., and does it go high enough where you start to then hurt your merchandising business, which is part of why gas station is very profitable. Is like they don't make that much on the gas, but they make a lot of in-store
sales,
and that's what Circle K and Couche-Tard has done very well. And the other competitor in the U.S., Casey's General Stores, has done very well also. So I think we really like Murphy's. The other reason about it specifically is that because of their agreement with Walmart, they can only redevelop or invest in so many stores per year because they can't go out and build 50 new stores or 100 new stores in a year because they need to get Walmart to approve the site before that happens. So there's sort of a slow walking of the investment, which is good because it means that they can't get over their skis.
They have to be careful.
They have to be careful, be slow. They've also been very prolific with buying back their shares. So share count, falls year after year, and as the store count grows, margins can normalize. I think it's a really healthy business, and it's sort of been one in this last month and a half that's helped us or helped the portfolio, given that what's going on in the rest of the market.
How important is it that they have the gas station and the convenience together?
It's critical. I mean, I think that ultimately, there's the other side of the argument on why gas stations are a bad business is because it's a commodity. So essentially, you're competing for price, and if you're any business where you're competing on who's the lowest cost producer, you have to have lower cost yourself to be able to have a margin. And so I think what businesses like Murphy's and Couche-Tard and Casey's General Stores have really turned to in the last decade is driving loyalty programs. And so if you can, if you make sure that customers go to your locations, they're getting gas, they're buying their newspaper or coffee or sandwich or Monster beverage or whatever it is. But you're getting points and all of that sort of. You own the customer or you provide value to your customer over and above your competitors. I think it creates a stickiness, which ultimately is what makes any business good, is that can you provide a service that your customers appreciate and do it over and over and over again? I think the nice thing about a business like that, when you've captured a market, is again, people need to go to the gas station every day. So it's a very consistent business, and people need to go to a gas station whether they want to or not. And if you can drive loyalty through your offering, you get a really stable customer base.
It's funny because you don't think of loyalty necessarily because it's a gas station, you just go to get your stuff, but people will go to the same ones if they know they're getting the price. Well, it's mostly the price on that stuff.
You get points, and maybe every I buy my dog food from a specific place because every 10 bags I get a free bag, and so Murphy's or Couche-Tard, if you are earning points every time you buy a sandwich or you buy a pop, you're likely to go back because that 10th time. You get a free one. And it's just those little sort of value-added customer experiences that make businesses stickier. And I think they've done a really good job at that.
And with you mentioned Casey's, because I think it's about 3 times larger, almost 3 times larger. Any interest in that, or?
So it's one that we've looked at. I think the challenge with Casey's when we first made the investment in Murphy's is Casey's was more expensive, and it's gotten even more expensive. The stock has done phenomenally well. I think it was actually just this week it was announced that it was going to be added to the S&P 500, so that was probably part of that. The Casey's, out of all of the gas stations, has by far the best merchandising and in-store experience, and so that's driven a premium experience. People are willing to pay more for the stock because of that perceived customer value inside the store. Murphy's was always gas station, was, even inside stores were a bit derelict. They've really invested in the last 10 years to make that better. But the consumer experience at Murphy's, we think, is underappreciated given their loyalty program. And so we think it's a better risk reward here than Casey's, but we like them all. We think they're great businesses.
All right, so Casey's has the best 1970s truckers 8-tracks, right?
Yes, perfect. And pizza and
I know where to go. Okay, lots more coming up. Still ahead, we're talking to Allison Freeman, CEO of Element Event Solutions, on its latest expansion, and our phone lines will open up. Pembina Pipeline expects to deliver 5 to 7% core profit per share growth through 2030. The oil and gas company will be supported by annual fees, higher utilization of existing assets, and contributions from new projects. The Calgary-based company says its long-term growth plans include investments in LNG, liquefied petroleum gas, gas to power, and emissions reduction infrastructure as well. Boardwalk Real Estate Investment Trust has sold 4 properties for a total of $105 million as part of their capital allocation strategy. The trust also repurchased more than 1 million units for $66 million in the first quarter of 2026. Calgary-based company says its portfolio occupancy remains strong at 97% as of this month. Anthropic says it's on pace to top $30 billion U.S. in annual revenue, up from $9 billion at the end of 25. The American company says demand for its cloud service has increased in 26, with more than 1,000 businesses spending more than $1 million U.S. on an annual basis. The AI startup is also confirming its plans to work with Broadcom and Google to power its operations. And a quick peek at the market, still off right now. As we look at the futures, the Dow by about 0.34, the NASDAQ by 0.6, and the S&P 500 by 0.43. Element Event Solutions recently announced a major investment in design, inventory, and premium experiences. But will it pay off? Here to tell us more about the company's big bet on the future of Canada's events industry is Allison Freeman, CEO of Element Event Solutions. Allison, thank you very much for joining us today.
Thank you so much. I'm delighted to be here.
Is it interesting times for your company right now with how everything is playing out? How are you handling it?
Yeah, it's really interesting times. And we're seeing a lot of strength in the Canadian events and hospitality sector. So, of course, the economy has been, all over the place. But we're seeing Canadians understand there's a fundamental need to gather. Gathering is fundamental to human connection, which is a pillar of our well-being. And we're seeing corporate Canada recognizing this as they're grappling with the sort of return to work in the virtual landscape. We're seeing the philanthropy scene. Canada's philanthropy scene is strong as Canadians are coming together to support our charities, our nonprofits, our community organizations. We're seeing sports and entertainment. We're all excited about FIFA coming to Vancouver and Toronto this year. So we are optimistic for the industry. We're seeing many signs of strength.
I mean, one of the things announced this morning is you've made one of the largest investments in the business in a long time. And one of the things we've been profiling in the last year is how businesses are navigating the tariff situation.
Yes.
And so I'm just wondering what that insight would be like. Was there a situation of picking and choosing based on that, or how have you navigated that as a business with the investment that you made?
Oh, absolutely. So we're really excited about our investment this year. It's our largest investment ever in our 115-year history. We've invested in over 200 new products across tabletop, furniture, tents, drape, decor. And with respect to the tariffs, absolutely. We've had to navigate shifting supply chains. So we source globally. We scour the vendors across the world in trade shows in Europe, in Asia, across North America. But we've absolutely had to adjust our supply chain in light of the dynamic tariffs. And certainly we're investing more in Canadian vendors. We're really proud to do that. And then it's more sort of direct purchasing to avoid the hit from tariffs.
Now, you've been around for 115 years, which is impressive for any company.
Yes.
How much does that institutional knowledge come into play when you're making decisions on such a large scale like this?
Yes. So we have been around for 115 years, and we are actually the unification of 9 of Canada's leading event rental businesses. So Element itself as Element formed in 2024, when we brought together the businesses and we recognized the need in Canada for a trusted Canadian brand offering a one-stop shop. And so we have brought forth the magic of each of those brands and the expertise and the wisdom, but we're creating a modern take on it all. Our investment this year was really informed by us talking to our clients. So our clients are Canada's leading venues, caterers, planners, corporate hosts. We talked to them to understand their needs. We also researched global trends. As I shared, we attended trade shows across Europe, and we brought that through in this year's investment.
You mentioned FIFA and sort of the World Cup event. So what's planned for that? That must be very exciting for the company and to be a part of that.
Very exciting. We're thrilled to be part of it. We are participating in the event itself in both Toronto and Vancouver, and then the Fan Fest really across the country. So we're providing our tents and structures as infrastructure for the games at both the stadiums and around it. We're providing our tabletop for the hospitality suites. And there's a ton of activity in the space, a ton of excitement, and it's wonderful to see the investment and the energy.
And with all these events, what do you think your greatest strength is for the company? What allows to continue and go for as long as it has and come together with other companies and merge? What do you think the greatest strength is?
Yeah, it's really our integrated solution. So we're the only business in Canada that can offer really a full solution for your event rental needs. So the tents and everything under it, tabletop, furniture, drape, linens, cutlery, glassware. We serve the entire event. We have Canada's broadest and deepest assortment, so we serve events of any scale, massive events to the backyard party. And it's the expertise of our team. We have an industry-leading team that understands the vision of each of our clients and uses their expertise in design as well as our assortment to bring it to life.
And that whole integrated system, what kind of a difference did that make to the bottom line when you brought that in and brought that together?
It was a massive transformation. I mean, across people, process, technology, consider 9 individual brands from Vancouver to Halifax. Bringing them together, we're experiencing growth. We're experiencing renewed commitment to the organization. We are clearly the leaders in Canada, and this investment in product just is a signal of our confidence in our business and in our industry.
All right, we have to wrap it up there, but Allison, thank you very much for joining us. We appreciate it.
Thank you so much for having me. Thank you.
And that was Allison Freeman, the CEO of Element Event Solutions. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including 2 new downgrades at BMO. And of course, our phone lines are open. Brad and Teish is taking your questions on North American equities. Call us at 1-855-326-6266. Email firstcall@bellmedia.ca. Let's take a look at some of the notable analyst calls and recommendations. Birchcliff Energy has been cut to market perform at BMO with a price target of $7. Advantage Energy was also cut to market perform at BMO with a price target of $12. On the other end, UBS has upgraded Morgan Stanley to buy from neutral, the firm citing that recent market weakness driven by the Iran war private credit concerns and AI disruptions presents an opportunity to buy quality stock. Well, an historic day for a mission truly out of this world. 4 astronauts have gone where no human has ever gone before. The Artemis II crew completed their lunar flyby, observing the far side of the moon. The crew captured endless photos and videos, but it was their description and firsthand account of what they were seeing that scientists are so intrigued by. CTV's Heather Butt has more.
From the cabin of integrity here.
A monumental moment for deep space exploration, marked with some poignant words by Canadian astronaut Jeremy Hansen.
As we surpass the furthest distance humans have ever traveled from planet Earth, we do so in honoring the extraordinary efforts and feats of our predecessors in human space exploration.
An historic milestone, the farthest humans have ever traveled from Earth. 4 astronauts on board the Orion space capsule, breaking the distance record set by Apollo 13 more than 50 years ago.
Today, for all humanity, you're pushing beyond that frontier.
Mission Control even sending a pre-recorded message from the late Apollo 13 commander Jim Lovell.
Welcome to my old neighborhood.
Canada's astronaut welcoming others to beat this record.
Importantly, choose this moment to challenge this generation and the next to make sure this record is not long-lived.
Then another milestone as the crew proposed naming 2 newly identified craters, Integrity after their spacecraft, and a second to honor a member of their space family, Mission Commander Reed Weissman's late wife.
It's a bright spot on the moon. And we would like to call it Carol. And you spell that Carroll.
The crew members embracing one another during an emotional moment in space. For several hours, their lunar flyby was under constant observation, with scientists on the ground watching and listening intently.
A deep hole, and then there's like 2 island rays pointing off.
My gosh, that was an amazing picture you just painted.
For billions of years, we have only seen one side of the moon as it orbits the Earth, much like 2 people circling one another, always keeping eye contact.
I don't know if Catherine and Devin are still there, but if they are, just wanted to just let them know how much fun we're having out here. It's extraordinary to be on the far side of the moon right now, just see it hanging out there and looking back at the Earth. And Ashley and Caitlin, I know you're back in Canada, but if you happen to be watching too, just wanted to say hi to all you guys. Love you guys. And we'll be heading back your way shortly.
That powerful message came just before the crew experienced a planned 40-minute blackout in communication with home base as they circled the moon. The capsule now en route back to Earth, which will take several days, with a scheduled splashdown on Friday. Omar.
CTV's Heather Butts. Well, maple syrup season may be one of Canada's sweetest traditions, but in the Maritimes, consistently cold temperatures are slowing sap flow. And for small producers, that can mean a big hit on their bottom line. CTV's Maria Saru has more.
Inside the Hazel Grove Sugar Shack, owner Greg Beamish opens a tap to a thin amber trickle. The evaporator is quiet. No sap coming in means no boil today. He says so far this is his worst season since starting this small operation more than a decade ago.
I'm noticeably further behind than I normally am. It'll be the first year in 12 years I have such little sap.
By now, he should have about 10,000 liters of sap boiled off. Instead, he's at under 3,500, putting production at about 1/3 of where it would usually be.
If I stay where I'm at, yeah, it'll be a poor year. It'll hurt my pocketbook in the long run.
Maple sap runs best when nights freeze and days thaw. But this spring has stayed too cold in some parts of the country, stifling the flow. In Quebec, producers recently reported running about 30% behind last year's pace. And it's what makers across the Maritimes are dealing with too, says the New Brunswick Maple Syrup Association.
If you did plan some investment to change equipment or whatever, you will need to wait another year.
For now, Beamish closes the lid and waits on a warmer stretch. There's still time for the season to turn, and he's hopeful. But each passing day leaves less room to catch up.
If production doesn't ramp up by the end of April, Beamish says he could run out of maple syrup to sell before Christmas. Maria Saru, CTV News, Rustico, Prince Edward Island.
And when we come back, Brad and Tice will take your questions on First Call. Time for first call and first email. That one is from Jim. I'm interested in the share buyback program at TELUS. Bryden, I don't know where Patrick came from, but is that your brother, Bryden?
No, I don't know, Patrick.
Is your view of this activity a reset toward a growth plan?
Thanks for the email, Jim, on TELUS. So I think the challenge for TELUS, similar for Bell, is you had a model that was very built on dividend growth.
Yeah.
I think the challenge as investment has ramped up in 5G for TELUS, I think they've had to dial some of those expectations back. And then, part and parcel of that, I think maybe they're doing a small buyback in light of that. I think it's a challenging moment for telcos because I don't think there's the pricing power in the business. And at the same time, companies have to maintain their level of investment to provide a good service. In TELUS specifically, they had really ramped up their 5G infrastructure investment, and that has started to curtail. But from a capital structure perspective, their debt levels are still a bit high. And so I think from a dividend perspective or share buybacks, I think expectations have to be lower for TELUS just because they're at an elevated level. And I think that can sort of provide for a more healthy overall capital structure for the business. So it's not one that we own. We did own it previously, but we've decided to focus our income investments elsewhere, more so on Canadian energy infrastructure, because we think that those are, in the moment, better businesses. But TELUS has been, a strong telco. It's a strong business, but I think they're a bit over their skis with regards to the dividend.
Yeah, and right now they're down 1% for the year. So considering everything that's gone on, it's not too bad. Okay, email from Mike. Would like to get your guest view on Visa for the next year. Break out the crystal ball. Thanks, Mike.
Thanks, Mike, for the question. So Visa, and the payment space, I think it's in a point of inflection here. I think the question, and a lot of these payments companies, obviously Visa and MasterCard are dominant businesses. Mm-hmm. They will continue to be dominant businesses. I think the question for them is, what valuation multiple is the market willing to pay for a great company? I think we've had, these businesses have sort of tread water from a valuation perspective for the last year, but there's no reason why you can't have valuations reset lower while Visa continues to be a great business. So you're kind of in this sort of paradox of, Visa is a great company. Are you paying too high of a multiple here? I'm not sure. I mean, with the risks in the market, we've seen this in the tech space. I think Visa is more immune to some of the concerns about software and AI, but there are going to be technology entrants who do try to combat or go after Visa and MasterCard's payment rails because they're so valuable. We've seen this. Global Payments has had a tough time. Fiserv is another payments company that does more bank-to-bank payments, and they've suffered. So I think the risk for Visa is that you have some kind of change to the payment system that leads to lower multiples, and it can still be a great business, but it doesn't mean the share price has to go up.
Yeah.
And so I think at this moment, it's sort of not one that we're looking at because of those reasons.
Could AI replace the credit cards in any way, or can they just really incorporate it?
No, I don't think so. I think there was a concern maybe 6-7 years ago, if blockchain and payment rails were going to be was that going to eat away Visa's business? Yeah. I'm sure what Visa and MasterCard are probably incorporating blockchain into their own business because I think they're dominant. Their platforms are so dominant. It's so built on trust and the relationship with the banks. And so I don't think that's likely to be disrupted, but it would be more just the valuation of the business I would be concerned about here. And so for those reasons, it's not one that we own.
Okay. Next up, email from, what happened here? Mike. Oh, no, that's we just jumped here. Email from Ben, sorry. Do you think it's a good time to pick up some Dollarama with the recent drop?
So thanks for the question, Ben. So Dollarama, again, it's another great business. It's had a great run the last several years. I think the concern, again, valuation is really high. Mm-hmm. I think their comments from their most recent quarter were that the economy or the consumer is slowing a little bit, which again, then the share price were down a little bit because of that. But if you were to have a recession in Canada, at some point we will, I think that probably would hurt Dollarama's multiple. I think they've done such a phenomenal job building their business. I think we completely missed the embedded pricing power, which was, the concern with the dollar store is if you sell items for $1, you can't really make money. But if prices go to $2 or $3 or $5,
you can make a lot of money.
And then they don't have to increase investment. They just raise prices. It's been a huge profitability boost the last 5 years for them. The market then rewarded them with a high multiple. So the stock's done really well. But if you have then change of expectations, you can still have a great business, but then the multiple starts to compress, and you might be at one of those inflections here with Dollarama now. So I think it's one to keep on investors' radar, but I would say that you probably have a good chance to buy it a bit lower than here, just because, again, the market, I think, is at a sort of a cautious moment.
All right. And we got one email from Gil. You got about 20 seconds. Okay, Shopify, buy or wait?
So Shopify had a good run. I think it's not one that we own. I think the question, again, with slowing consumer, they've made big investments. So I think that they've proven themselves as the dominant platform. Again, it's what price are investors willing to pay. We've seen software come under pressure. And so I think Shopify here probably has a little bit more risk to the downside.
All right, got to wrap it up there. But thank you, as always, Bryden, for joining us. That is it for us here on The Street. Thanks to Bryden for joining us today. And he's up next with the open. Trading gets underway in a little more than 30 minutes. Have yourself a great day.